Cost of capital, end of chapter questions. Starting with question number 1. The cost of equity, KE, we just discussed a little while ago, is equal to what? Expected market return? No. Required rate of return required by the stockholders? Yes. Cost of equity is the return required by the stockholders. Correct. Cost of equity is equal to cost of retained earnings plus dividends. No such thing has been learned. It's a ridiculous option. So yes, it's the rate of return required by the stockholders. That makes B to be the correct option. Which of the following statement is correct? The appropriate tax rate to use in the adjustment of the before tax cost of debt is to determine the after tax cost of debt. When we calculate the cost of debt, that is the yield to maturity, or if it is coupon, multiplied by 1 minus tax rate, right? For this rate, which rate should we use? The appropriate tax rate to use in the adjustment of the before tax cost of debt to determine the after tax cost of debt is the average tax rate. Average tax rate is calculated for income statement purposes. This is not the tax we pay. Ideally, if we have the tax rate available for the next couple of years, the expected tax rate, either this or the rate that has been substantially enacted, because your cost of debt is for the future calculation of future weighted average cost of capital for investment appraisal. So we should first consider any expected rate that is likely to be enacted, or substantially enacted rate, or if not possible, then the enacted rate. Average tax rate is for only accounting purposes. It's not the effective tax. It's not the tax benefit that you get from the tax authorities, because interest is a tax allowed expense. It's a tax deductible expense, and the benefit is only calculated on the enacted tax rate. Since it's for the future, so it's expected or substantially enacted into the law, or the rate that is currently in force for the foreseeable future. So this is not right, not average tax rate. Wrong. For a given company, the after-tax cost of debt is generally less than both the cost of preferred stock and the cost of common stock. This is absolutely right. The cost of common equity is greater than the cost of preferred stock. It is greater than the cost of debt. The reason being, first of all, the cost of debt is lower because of its less risk. The debt holders faces less risk than the equity holders. This is the first reason. And second reason is that the interest is tax deductible. These are the two reasons why the cost of debt is the lowest. So yes, after tax cost of debt is generally less than both the cost of preferred equity and the cost of common equity. This is a perfect, correct statement. We don't have to go any further, but still let's read option C. For a given company, the investment opportunity schedule is upward sloping. Wrong. Investment opportunity schedule is downward sloping. MCC is upward sloping. So this is not upward, rather it is downward sloping. We invest in those projects that give us the highest return, and we keep on going till the funds are fully utilized till this point. So that makes B to be the correct option. This was given right here. See, this is negatively sloping curve. Next, using the dividend discount model, DDM, what is the cost of equity capital for Zeller Mining if the company will pay a dividend of 2.3 next year? This is D1. Has a payout ratio of 30%, dividend payout ratio of 30%. Return on equity 15%. And the stock price currently is Canadian dollar 45. We need to calculate what? The cost of equity. For cost of equity, we need to have D1, which is there, price there, growth rate. We don't have growth rate. D1 is there, yes. The next dividend is going to be 2.3. Will pay. Will pay means it's the future dividend. The dividend that has just been paid, it is D0. Right? For that, we use this formula. K is equal to D0 into 1 plus G upon P plus G. Right? This is the formula we use if we are given the current dividend that has just been paid. If it is D1, you simply use this formula. So we have been given the dividend 2.30. We have been given the share price, that is what, 15 that is $45 here. Right? We don't have growth. what to do. For growth, we can use the formula we just discussed a little while earlier. Sustainable growth rate is equal to 1 minus dividend payout ratio multiplied by the return on equity. 1 minus dividend payout ratio is 30%. Return on equity is given as 15%. So it's going to be 70% times 15%. It's going to be 10.5%. Now this is your growth rate. Simply plug in this growth rate calculated from sustainable growth rate formula. So D1 upon P, convert this into percentage and add to this 10.5, you should get 15.61%, and that makes C to be the correct option. So this is how you use the dividend discount model to calculate the cost of equity. C is the result. .com has determined that it could issue 1,000 face value bonds with an 8% coupon paid semi-annually. Okay, now we have the information. Face value is 1 negative because you have to redeem it on the date when the bonds mature. Interest, since it's a semi-annual one, rate of interest to be divided with 2, that's 4%. 4% of 1,000 means 40. It's a payment outflow. Face value will be a payment in the future when the bond is redeemed. So negative 1,000 PMT, negative 40. It's a 5-year bonds. It means N is going to be 5 times 2, 10. 900 per bond. This is present value. What we are required to do, use the TVM function of your calculator. All these 4 are given. 5th can be calculated. CPT, interest rate per period, is 5.33149. Since this rate is for semi-annual payments, so you have to multiply this with 2. This will give you 10.6298%. This is your yield to maturity, 10.6298. Now you can use this rate to calculate the after-tax cost of debt. What is the after-tax cost of debt? KD is equal to, we were given coupon as well. We didn't use coupon. If the data is given, we should ideally use the yield to maturity. 10.6298 multiplied by 1 minus tax rate. Tax rate is 30%, 38%. So this percentage into 1 minus tax rate gives you 6.59%, and that effectively is 6.6%. This is the after-tax cost of debt, lower than the coupon. That's why debt is the cheapest source of finance. But as the leverage increases, the return, the interest required by the bankers, it goes up as well. The return required by the investors goes up. So C is the right answer. The cost of debt can be determined using the yield to maturity and the bond rating approaches. Yes, we just calculated the cost of debt using yield to maturity. If the bond ratings approach is used, the coupon is the yield? No. Yield is based on the interest coverage ratio? No. Interest coverage ratio is the comfort with which the firm can pay interest out of its operating earnings. The bond rating approach is used when the company is rated, and the rating can be used to assess the credit default spread of the company's debt. What is the credit default spread? It is the difference between the US Treasury bonds ratings and the ratings of the firm's bond. This gap, this difference between the US Treasury bonds ratings and yours, this is called the credit default spread. This is another way to calculate the cost of debt. That makes C to be the correct option. Next. Morgan Insurance Limited, you issued a fixed rate perpetual preferred stock 3 years ago and placed it privately with an institutional investor. The stock was issued at 25 per share with $1.75 dividend. If the companies were to issue preferred stock today, the yield would be 6.5%. The stock's current value would be, the current share price of preferred stock is equal to dividend divided by the yield, 6.5%. So the dividend that is being paid is 1.75. The yield is 6.5%. So dividing the dividend with the current yield will give you $26.92. That's the current share price, current preferred stock price. Here we go. A financial analyst at Bookhook Limited wants to compute the company's weighted average cost of capital using the dividend discount model. Okay. The analyst has gathered the following data. Before tax cost of debt, tax rate is given, debt to equity ratio is given 0.8033, stock price is given, next year dividend is given, and the estimated growth rate is given. What do we need? Weighted average cost of capital. Before calculating weighted average cost of capital, we need to calculate the cost of debt and the cost of equity. How do we calculate the cost of debt? Yield to maturity, coupon, whichever is suitable. And I think we have been given before tax cost of new debt. This is what we should take now. Into 1 minus tax rate is 40%. So 1 minus 40%, 60, 16 to 8, that is 4.8%. Cost of equity using the dividend discount model. That is next dividend. Yes, we have been given next dividend upon the current share price 30. To this add the growth rate, and we have been given the growth rate, estimated growth rate. If not given, we will be using the sustainable growth rate using 1 minus dividend payout ratio into return on equity. So 1.5 on 30 plus growth rate 7. If you convert this part into percentage and add 7 to it, you should get 12%. So cost of equity is 12%. Cost of debt is 4.8%. Now the next part, we need to calculate the weights, weightages, percentages, proportions. Debt to equity is 0.833. What about debt to debt plus equity? That's what we need as a way to calculate the weightages of debt and equity. So it's going to be 0.8033 upon 1 plus 8.033. Debt of, because what you have been given is debt over equity. We need debt over debt plus equity. Debt is what proportion of the total funds. So for that, simply do 0.8033 upon 1 plus 0.8033. When you calculate this, it will give you a weightage of approximately 44.5%. So it means debt is 44.5% of the total fundings deployed. And what about equity? 100 minus 44.5, that will be simply 55.5%. Now it's very easy for us to calculate the weighted average cost of capital. Debt is 44.5% of our fundings, and the cost of debt is 4.8, plus equity is 55.5% of our funding, and the cost of equity is 12%. So now you can get the idea. We have some funds at a cost of 4.8 and their weight is 44.5, which is debt. We have some funds at a cost of 12% and their weightage in our composition is 55.5. Solving this will give you 8.796%, which is approximately, of course, not far away from 8, close to 9, so it is 9%. That makes B to be the correct option. Absolutely right. Next, the gearing company has an after-tax cost of debt capital of 4%, that is KD. A cost of preferred stock of 8%, that is KPS. These are the conventions I have been using for the last 10 years. Even your curriculum might be using different, maybe they use, I think they use KCE, but this is what I've been using for many, many years, so they're just hanging around with me. A cost of equity capital is 10%. Cost of equity, or common equity, is 10%. So we have been given cost of debt, cost of preferred stock, and cost of equity, and as you can see, cost of debt is the lowest. Right, and a weighted average cost of capital of 7%. Okay, WACC has already been calculated for you. Now what is required? Gearing intends to maintain its current capital structure, since the target capital structure is the same as the current capital structure, and as it raises additional capital, in making its capital budgeting decision for the average risk project, mind the word, two things are pointing us in a specific direction. First of all, your target capital structure is the same, and the project that you're going to take is nothing new For that, we have to find a comparable. We need to find the unlevered beta and then relever it. There is no such thing. Since the target capital structure is the same, since the project is average risk, hence there is no need to go here and there. Simply use your current weighted average cost of capital. Absolutely. So go for 7%. That makes B to be the correct option. Next, Fran McClure of Alba Advisor is estimating the cost of capital of Frontier Corporation as a part of our evaluation analysis of Frontier. McClure will be using this estimate along with projected cash flows from Frontier's new projects to estimate the effect of these new projects on the value of Frontier. McClure has gathered the following information on Frontier's Corporation. We have been given book value of debt, market value of debt, current year. We should take this. Book value of shareholders' equity, market value shareholders, yes. We have been given the forecast for the next year. Book value is irrelevant. Since we have been given the expected market value for the future, this is more relevant to calculate the cost of capital for the future projects. Now, the weights that McClure should apply in estimating Frontier's cost of capital for debt and equity are respectively what? 63 and 220. These are the two proportions we will use. So for debt, it's going to be 63 over 63 plus debt over debt plus equity. Remember, debt over debt plus equity, that is 63 plus 220. And for equity, it is equity over debt plus equity. Right? These are the total funding, 63 and 220. Out of it, 63 came from debt and 220 from equity. You just need to calculate the percentages or in decimals. So the first is 0.223 and the second is 0.777. That makes C to be the correct option. Correct. Next, Wang Securities had a long-term stable debt-to-equity ratio of 0.65. This is the stable debt-to-equity ratio of 0.65, which tells us that for every $1 of equity, the business has deployed 0.65 of debt. For every $1, against every $1, there is $0.65 of debt. Recent bank borrowings for expansion into South America raised the ratio to 0.75. The ratio has changed. The increased leverage has what effect on the asset beta and the equity beta? Asset beta is called the unlevered beta. It is not affected by leverage. And equity beta, it is influenced by leverage. Remember, asset beta is unaffected by the business leverage. Equity beta is affected by the leverage. So what is the right option? The asset beta and the equity beta will both rise? No. The asset beta will remain the same and equity beta will rise. Why? Because leverage has gone up. For every $1, first you had 0.65 of debt, $0.65. Now for every $1 of equity, the debt is now a larger proportion. That's why the leverage has gone up. Resultantly, this has increased the risk and equity beta would change. So equity beta, of course, risk goes up, equity beta will go up. So that makes B to be the correct option. B it is. Next, Brandon Wayne is a financial analyst covering the beverage industry. He is evaluating the impact of DEF beverage new product line of flavored waters. DEF currently has debt to equity ratio of 0.6. Current debt to equity is 0.6. The new product line would be financed with 50 million of debt and 100 million of equity. The new project involves 50 million debt, 100 million equity. Then debt to equity has changed from 0.6 to 0.5. It's no longer same. In estimating the valuation impact of this new product line of DEF value, Wine has estimated the equity beta and the asset beta of the comparable companies. Right thing. In calculating the equity beta for the product line, Wine is intending to use DEF's existing capital structure. Why existing capital structure? Beta, since your leverage has changed, it will change the equity beta as well. So why existing capital structure? Why 0.6? The new project is different, it's 50, 100. So when converting asset beta into project beta, he should revise the beta now. Which of the following statement is correct? Using DF's debt to equity ratio 0.6 is appropriate, not appropriate. Debt to equity has changed. Using DF's debt to equity ratio 0.6 is not appropriate, but rather the debt to equity ratio of new product 0.5 is appropriate, and to use it to calculate the new equity beta. Perfect. B is the right answer. B is the correct answer. I need space for this question. I need space for this question. All right. Happy Resorts Company currently has 1.2 million common stock of shares outstanding, and the stock has a beta of 2.2. Okay. It also has 10 million face value bonds that have 5 years remaining to maturity and 8% coupon with semi-annual payments. Okay, now this requires some calculations, and are priced at 13.65%. This is the yield. Price to yield 13.65%. If Happy issues you who? Something is fine. To 2.5 million of new bonds, the bonds will be priced at par and have a yield of 13.65%. So we are going to issue new equity and new bonds. This much the funding will be raised. If the issue bonds beyond 2.5 million, the expected yield on the entire issuance will be 16%. So going beyond 2.5 million, additional bonds will require cost of 16%. Additional marginal cost of capital, every additional dollar raised will involve more cost. Happy has learned that it can issue new common stock at 10 per share. The current risk-free rate of interest is 3% RF, and the expected market return is 10%, that is RM. We'll extract all this data slowly as we go along. Happy's marginal tax rate is 30%. If Happy raises 7.5 million of new capital while maintaining the same debt to equity ratio, which is we don't have yet, its weighted average cost of capital is closest to. We have to calculate the weighted average cost of capital. We do not have the weightages of these individual components, neither equity nor debt. We do not have their costs, so it's a long question. We will first calculate the market value of debt, market value of equity. Then we will calculate the cost of debt, cost of equity, using the market values as the proportions and the calculated cost of equity and debt. We can calculate weighted average cost of capital. So easier said than done. Let's do it. First, calculate the market value of debt. What's the face value of the bond? 10 million. Since the interest is paid semi-annually, this one here, semi-annually. So what would be the coupon payments? 8 upon 2, 4. 4% multiplied by 10 million. It means the PMT is 0.4 million. Right? Next. The term to mature 5 years remaining. That means since we are taking semi-annual payments, so it's going to be 5 times 2, 10. N is 10. What else do we need? We have FV, we have payments, we have N. What else do we have? Yes, we have been given the yield 13.65%. It has to be divided with 2. Dividing 13.65 with 2 will give us the relevant yield, and it's going to be 6.875. 6.875. Okay. Plug in all these in your TVM, in your financial calculator. Compute present value. What you will get is 79998,687.644, which is approximately 8 million. Now the next point is to calculate the market value of equity. How many shares are in issue? 1.2 million. What is the current share price? 1.2 million, and current share price is 10. So 1.2 million into 10, that is 12 million. Now since we have the market value of debt 8 million, market value of equity 12, so calculating these as basis 8 plus 12, 20, 8 by 20, 40%, 12 by 20, 80%. So the first element is done. We have calculated the market weights. Market weightages have been calculated. The next step is to calculate the cost of debt, then cost of equity, and then using these costs and these weights, there we go. We can calculate cost of weighted average cost of capital. Why did we not use the new data? Why? The reason is that the current capital structure will stay and we will use this proportion. Cost of debt is equal to the coupon, the expected yield. Here, if Happy issues 2.5 million new bonds, the bond will be priced at par and have a yield of 13.65. If it issues bond beyond 2.5 million, the expected yield on the entire issuance will be 16%. Now, Happy has learned that it can issue new common stock at 10 and new bonds will be issued at a cost of 16%. So you will take cost of debt as 16% multiplied with the tax rate is given as 30%. So 16 into 1 minus 30. So its simplification will give you 70 times 16. That is 11.2%. This is your cost of debt to be used for weighted average cost of calculation. Cost of equity. Since we cannot use the dividend discount model because we have not been given the growth rate, we have been given the risk-free rate, that is RF. We have been given the beta 2.2. We have been given the expected return on the market, that is 10% expected return on the market, and risk-free rate. So it's going to be 10 minus 3, 7. 7 into 2.2 plus 3 gives you 18.4%. This is your cost of equity. Now we have to calculate the weighted average cost of capital. We have the weight of debt, that is 40%. Weightage would be the same. The cost goes up to 16%. 40% times 16 plus it's 60%. Weightage of debt is 40 and 100 minus 40. The weightage of equity is 60%. So 60% of 18.4 and you will get your result 15.52. That makes B to be your correct option.